Budget 2026 just ended. The US India trade deal happened. And honestly, a lot of investors I speak to, they're confused or panicking. Options just got more expensive. Gold SGB rules changed. Equity gold and silver corrected and then bounced back too. So some people are exiting, some people are freezing. I'm actually deploying money. So instead of debating the budget or the trade deal, I asked myself one simple question. If I had to invest fresh money today, where would it go? So what I'm doing with my own money, how much I'm putting into gold, which equity funds I'm buying, when I'll supplement my international exposure, and what I'm doing with arbitrage and hybrid funds after the STT hike. So if you are worried about rupee risk, volatility, or the new SGB rules, watch till the end. I'm sharing my actual allocation, not just opinions. First, very quickly, the budget changes that actually matter. So STT on FNO has gone up, which means options are now meaningfully more expensive. So this impacts frequent traders and arbitrage strategies. Then there is SGB rule change. So if you buy SGBs from secondary market, gains at maturity are no longer fully tax-free. And coming to equity, this correction has opened better pockets, especially outside the Nifty 50. That's the context. Now let me show you what I'm actually doing. Gold and silver rupee risk. So I'm trying to take gold to over 20% of my net worth. Not because gold has done well recently, but because I do not trust currencies. And that includes rupee as well. And I'm talking about over the next 10, 20 years. Governments across the world are running deficits, printing money, and changing rules. Currency debasement is no longer a theory. Most investors I speak to ignore rupee risk completely. My thinking is simple. If I'm earning, saving, investing, and retiring in rupees, I do not want 100% of my wealth dependent on rupee behaving perfectly forever. That's where gold and international equity comes in. I'm not saying the rupee will collapse. I just do not want entire life savings tied to one currency. Geopolitically, also with leaders like Trump constantly introducing tariffs, trade wars, and policy uncertainty, it is very hard for the world to stay in a stable status quo mode. Historically, long periods of uncertainty tend to favor gold. Over the last couple of days, I have added a meaningful amount of gold and silver. I'll keep adding as long as prices make sense. When the prices go beyond my buy levels, I'll again start adding them via multi-asset funds. My goal is simple. We'll take my gold and silver allocation to 20% plus of my net worth. And crashes like these are opportunities for me. Now, the big question is, should you still use SGBs or is ETF better after the tax rule change? I did not want opinions here, so I ran a very simple conservative comparison, did some calculation. I compared buying SGBs first, then moving to ETFs versus just buying gold ETFs and holding them long term. I'll put the calculation on screen so you can pause and check. But here is the conclusion that surprised even me. Even after cutting SGB interest to just 1% instead of 2.5% and taxing it heavily at 31.5%, SGB plus ETF still came out ahead, not by a massive margin, but enough to matter. And the reason isn't the interest, it is the expense ratio. That 0.8% ETF cost looks harmless, but it quietly compounds against you every single year. So for long-term allocation, cost matters more to me than liquidity. But one clarification, gold ETFs still make sense if you need frequent liquidity or flexibility. For me, because this is long-term money, SGBs remain my first choice unless they are trading at premium. So I'll keep adding as long as opportunities arrive and until I meet my target allocation. Now let's move to equity. So if you have followed my earlier videos, you know I do not like paying extreme valuations or even buying at high levels. For a while, markets felt expensive, so I leaned more on multi-asset and relatively defensive strategies. Post this correction, I find Nifty Next 50 reasonably valued, though it increased by 3% today. So I have started increasing allocation there. If it corrects further, I'm okay. In fact, I'll buy more. Alongside that, there are a few individual stocks where valuations finally look acceptable. I'm adding gradually, not all at once. Next is international allocation. I do not want to be 100% dependent on India and the rupee. Over time, I want international equity exposure to move towards 15% to 20%. Right now, US markets are not cheap. And with tariff talk and policy uncertainty, Mr. Trump, volatility is very much possible. So my plan is very simple. First, explore gift city funds once they are available and have some track record. Specifically one fund. Second, scale up meaningfully only when valuations become more comfortable. I'm not rushing into every new international fund just because it launches. I already have international exposure via multi-asset funds. Then I've got ESOPs and then China funds. For incremental money, patience matters more than speed. I try to remember that and I keep telling this to myself. Next is arbitrage and hybrid funds. Arbitrage funds used to be an easy, low volatility option with equity like taxation. With this STT hike, returns could take a hit, roughly by around 0.5% per year. So this also affects equity savings funds and multi-asset funds because they rely on arbitrage to maintain equity-like taxation. Right now, I am not doing anything with that because I want to see how AMCs adapt their strategies over the next few months. They may still remain the least bad option for certain goals, but I want data before making decisions. I do not want to assume anything. For me, the STT hike and all this noise isn't the main story. The real story is this: markets are going to probably stay volatile, and that is exactly when serious investors quietly build positions. My opportunity fund is getting used up faster now because I actually like these phases. I bought a lot during these crashes. So my post-budget 2026 positioning is first, adding to gold via SGBs when prices are reasonable. If SGBs are at premium, then I'll buy ETFs. I'll also add silver if crashes like these continue. I'll buy silver via ETF. Second, increasing Nifty Next 50 and selected stocks on sensible valuations. Third, raising international equity towards 15 to 20%, but only at better valuations. I do not like to chase. And last one is continuing arbitrage and equity savings for now, while closely tracking post STT returns. So, what about you? Are you adding gold, US markets, or sticking to Indian equities? Tell me your allocation in the comments. I read most of them. If you like this way of thinking, not panicking at every rule change, but adjusting the plan, then hit like, subscribe, and share it with someone who is confused after Budget 2026. This is not an investment advice. Please consult a qualified financial advisor before making any kind of financial decisions. Thank you and have a blessed day ahead.